Have you ever wondered how banks really work behind the scenes? From collecting deposits to managing risk and making loans, join us on a journey to discovering secrets behind vault doors and unravel the mysteries of modern banking. First, we must understand where banks get their money, and that starts with a purchase. Money is their inventory. The highest going rate for cash is usually through the country's central bank, like the Federal Reserve in the US. Their preferred method, however, is to collect deposits from clients, paying a lower interest rate comparable to what other banks are paying on savings accounts. In case of liquidity needs, which we will talk about in detail later in this video, they can also borrow from other banks in the interbank market or by issuing debt. Once they are well established, profit retention and other services such as payment processing, fraud protection, and service fees can also be a source. Once they have the money, they can't just lend it all out. You might want to use your money. So the Fed places reserve requirements on banks to ensure they can meet customer withdrawal demands. The reserve requirements vary by bank size, but many banks try to retain a reserve of 20%. For those of you that follow financial news, you might have heard of a regional bank in New York recently suffering a drop in stock price. This was caused by them passing a regulatory threshold asset size of $100 billion faster than expected, resulting in a surprise loss and dividend reduction. Now that they have the money and have met reserve requirements, they get to start creating money from their money. Banks lend the money at a rate usually 3 to 6% above what they pay on deposit for that money, creating a profit margin. Loans are given for personal and business purposes, including mortgage, cars, equipment, credit cards, commercial property, agriculture, and revolving lines for operating cycle. But wait, there's more. Ways to earn money. Large banks offer foreign exchange services and international transfers through which they gain profits on margins for exchange. This can be a win-win for you. Airport exchange locations make money the same way, but charge 2 to 3 times more on average. They can also offer wealth services, as long as it's done clearly separate from where they take deposits, and earn margins for portfolio growth, insurance, and consulting fees. Treasury services, including credit card processing, direct deposit, lockbox services, fraud protection, and so much more can add fee income. With so many ways to make money, why don't we have banks everywhere? Well, in some cases, like the US with our 4,000 banks, we do. But we can't talk banking without talking risk. Banks are attacked on multiple fronts, being seen as a business literally made out of money. Losses can happen through embezzlement if proper procedures are not in place. Lack of trust in a bank or its stability can result in bank runs, such as last year's failure of Silicon Valley Bank. Fraudsters also constantly find new ways to steal from individuals and use social engineering to trick employees into bypassing security measures. Sometimes, losses also come from borrowers who can't or won't pay their loan back. On top of those risks, which cost the bank not only in loss, but in the need to staff departments dedicated to risk management, due to being federally regulated, they are also subject to external auditing for these regulations that can carry legal penalties for failing to maintain, and third-party strength ratings that can impact trust in them. So that is how banks create money. Did I miss anything? Feel free to post any questions in the comments, and if you like this video, please subscribe for future content like this.